Well, ahead of the third Monetary Policy Committee, the Monetary Policy Committee will be meeting on Monday and Tuesday next week for the third time this week. The last meeting concluded with a hold position. South Africa concluded theirs yesterday with a hold position also. Well, with the inflation figures released, this would marginally, how will this affect the decision of the MPC, which is holding Monday and Tuesday? We have Omotola Abimbola, an analyst with Chapel Hill Denham, to tell us what she thinks about this. Good morning, Omotola, and thank you so much for joining us on the show.
Good morning, Chimeze, and thank you for having me.
Okay, actually, it's Ini and Ladi today. So as we approach the upcoming third MPC meeting of the year next week, what's your expectation? South Africa had theirs yesterday, and it was a hold position. Of course, ours last month was a hold position also. What do you expect?
Well, our view is that very likely the monetary policy will be sending out more hawkish signals at the meeting, because if we just cast our mind back to the last MPC we had in March, although we had the committee member vote to actually hold the monetary policy rate at 11.5%, 3 members actually voted for a hike in the benchmark interest rate by between 50 basis to 100 basis points. So, although the meeting was a hold decision, it was slightly hawkish based on the voting pattern. I think something very similar will occur at the MPC meeting next week. And our reasons are two. I mean, macroeconomic instability still remains a major challenge in Nigeria at the moment. We have headline inflation rates very elevated, above 18%. Although we saw a slight reduction at the last meeting, but it's still significantly above the long-run level, 12%, and very much elevated. Also, if you look at the external sector balance as well, we are seeing a lot of challenges there. The current account balance data that was published by the Central Bank of Nigeria, just 2 weeks ago, perhaps better explains that as we saw current account deficits actually expand on a quarterly basis, despite the fact that we have had series FX depreciation. If you look at the foreign exchange rate markets as well, we are still suffering from a liquidity scarcity problem in the FX market. So, from macro stability points of view, we have a number of unresolved challenges that would require a much more tighter monetary policy framework to solve. Also, beyond the macro instability challenges, if you look at economic growth, where the CBN has sort of adopted to be one of their key mandates at the moment. Last year, the central bank adopted an extraordinary dovish monetary policy to support the economic recovery during the COVID-19 pandemic period. We saw 200 bips interest rate hike. We saw the central bank allowing liquidity to build up in the financial system to assist corporates, businesses, and even households and individuals to be able to, have access to cheap financing to support them during the pandemic period. And having done that, they've succeeded, at least based on the Q4 GDP number that came out, for 2020, they've succeeded in achieving a very swift return to growth. And by next week, when we see the Q1 2021 GDP data, that would likely further indicate even further consolidation of that growth momentum. Okay. So with growth, turning back positive, very likely the MPC will probably, wants more or less focus on the macro instability, issues facing the country.
All right, Omotola, but earlier this week, the MBS published the April inflation figures, which was better than analysts expected. How would this affect the MPC's deliberation?
Well, it depends on how the MPC views that data, because prior to the publication of that data, we have had, more than a year uninterrupted, persistent increase in headline inflation rate. Between September 2019 and March 2021. We saw a persistent increase in the headline inflation rates in Nigeria. But in April, we had a positive surprise with the 5 basis point moderation in the headline inflation figure. So I guess the key question for the MPC will be that positive surprise that we had in April, is it just a transitory effect? that will likely not persist going forward, or have we actually reached an inflection point where we should expect inflation rates to continue to decline going forward? So their response to this particular question, whether we are at an inflection point or it's just a transitory or a momentary drop in headline inflation rates, the answer to that question will probably increase the decision at the meeting as well. But what we think is that, what we had in April is likely a transitory effect, and we're likely going to continue to see headline inflation rates remaining under pressure, at least in the first half of 2021. Meanwhile, when we go to the second half of the year, and we start seeing the base effect having a significant impact on the headline inflation figure, then we should begin to see a much more persistent disinflationary trend. So we are still very uncertain for now whether we've reached an inflection point and inflation has peaked, or what we had in April was just a momentary drop, in the headline inflation figure. But I think the MPC will be looking for an answer to that.
Well, we also have the GDP report for the first quarter of this year scheduled to be published on Monday. What's your expectation? And will this in any way affect the MPC's decision?
Very much, it should. As you mentioned, we are having the Q1 2021 GDP data scheduled to be published by the MPS on Monday. And our view is that we're going to see a consolidation of that nascent recovery that we had in Q4 2020. In Q4 2020, we had GDP growth come mildly positive, just about 0.1% year on year, which is within a margin of error. But what we think is that in Q1 2021, we're going to see a consolidation of that recovery, which is much more stronger GDP growth momentum. Currently, our estimate is 0.5% year-on-year expansion in GDP. And that recovery, we think, will be driven mostly by the non-oil sector, where we have sort of, reached a turning point due to the fact that the government has, to a very large extent, reopened the economy, back for business activities. And we are also, seeing the positive knock-on impact of strong government spending and the CBN's, accommodative monetary policy. So we think all these factors should probably lead to an expansion in the non-oil sector of the economy. Meanwhile, the oil sector of the economy is still expected to remain under pressure, largely because of the OPEC Plus production cut agreement, which has more or less trimmed Nigeria's, oil and gas production numbers. But by and large, we think we should see a GDP print, which is just a reflection of the positive knock-on impacts, both the CBN and also the Ministry of Finance, what they have done in terms of trying to stimulate the economy, particularly at the peak of the COVID-19 scares. And we think that even going forward, by the time we start seeing the Q2 and the Q3 GDP prints, we probably see even a much more stronger rebound in the GDP numbers as base effect sets in. And regarding how this will have an impact on the MPC meeting. So for the MPC meeting, the CBN, by their core mandate, from their core mandate, they have a core mandate of price and exchange rate stability. But over the past couple of years, certainly the tenure of the current CBN administration, also the CBN actually venture into growth and development objectives. So beyond their primary mandates of price and exchange rate stability, they've taken on additional mandates supporting economic growth and development, which is why, last year we had an extraordinary dovish monetary policy to support the economy. So as the economy is now back on the growth terrain, I think the expectation is that some of those accommodative policies they put in place last year will be gradually withdrawn in order to allow them to focus more on their primary core mandate of achieving, low and stable inflation, as well as having a stable foreign exchange market. Those particular goals, have been put on the back burner, primarily because the CBN's aim last year was support economic growth. The economy now back in the growth terrain. I think, we should begin to see the CBN now begin to focus more on their primary mandates of price and exchange rate stability, which will probably lead to, much more higher interest rates going forward.
All right, going forward now, looking at the markets, how do you expect the financial markets to react to the meeting, maybe a possible hold or hike scenario?
So the interesting thing about the financial markets is that it usually leads what happens to monetary policy. So monetary policy typically lags the response from financial markets. And why do I say so? If you look at the financial market today, particularly the fixed income markets, the market has more or less, priced in a much more tighter monetary policy, going forward. Because over the past 4 to 5 months, we have seen a very sharp uptick in interest rates. If you look at the short end of the curve, primarily looking at the treasury bills auctioned by the federal government of Nigeria, last year we saw the 1-year auction rate, clear at a record low of 0.15% around November. Today, at the last auction that we had, last week, we saw the same 1-year rate actually clear at 9.75%. So to a very large extent, the fixed income market has actually, priced in a tight monetary policy framework, which is why, interest rate environments today, they are very, very elevated, at least compared to where we were coming from. But then if we should see a very strong hawkish signal from the MPC, then perhaps the markets will price in, further expectation of a high interest rate environment. But if the decision is a hold, I think market will just carry on as normal and yield will remain stable at this level.
Okay, all right. So just before we let you go and away from the MPC now, when the IMF revised its 2021 growth projections to 0.3%, it was hinged on the progress of vaccination globally. Now, how's that going in Nigeria, especially now that the PTF has reintroduced a level of restriction? How is it affecting investors' decision? How is it affecting the economy and the parameters in the economy?
Thanks for the question. So I believe that the global vaccination campaign is been mostly mixed. On one hand, we are seeing a very strong vaccination campaign in some advanced economies such as the US, United Kingdom, and even Israel, where they have vaccinated nearly or over 50% of their population, at least on a post-vaccine basis. And then we have the other half in the developing world, including Nigeria, where vaccination campaign has been very, very slow. So today, just about 1% of Nigerian adults have been vaccinated with the COVID-19 vaccine. So there's still a lot more to be done in trying to ensure, improved coverage of vaccination. And I think there's a lot of things to be done regarding both demand and supply. On the demand side, I think a very major proportion of Nigeria's population, they are still vaccine skeptics. So more enlightenment has to be done to ensure that more people show up for vaccines. And also from the supply perspective as well, we also need to get or diversify our source of, getting COVID-19 vaccines. We were depending on India initially, but given the challenges and the setbacks they are witnessing in the country, they have more or less, stopped export of vaccines into other countries. So we need to diversify our source of vaccines as well to ensure that we're able to rapidly cover, more of our population. Now, regarding how the recent restrictions will affect economic activities going forward, I think to a very large extent, the economy has moved on from the very, very harsh level of restrictions that we had before. What the PCF did recently was more or less from an advisory perspective, where state governments, are still primarily responsible for actually setting policies in their state regarding COVID-19 related restrictions. So, and for many state governments right now, they haven't, come out to actually introduce more restrictions. So, to a very large extent, I think that we've seen the worst, the pandemic, in terms of restriction, and going forward, particularly due to base effects, the economy begin to show even stronger momentum going forward.
Well, we certainly hope so, Mr. Abimbola, that we've seen the worst. I mean, because there's been warnings, especially after what happened in India. But thank you so much for sharing your thoughts with us this morning. Omotola Abimbola, analyst with Chapel Hill, Denham, and enjoy the rest of your day.
My pleasure.